Suprajit Group. We've got Ajith Kumar Rai, the founder and chairman, joining in on the show right now. Ajith, hi, morning. Good to have you on ET now. Let's talk about the GST on auto components, which has now been rationalized to 18% from the earlier 28%. How is it that you're leveraging this structural cost reduction? Does it really create room for margin improvement or pricing flexibility for you?
Good morning, Aisha, and thank you for having me on your channel. The GST reduction from 28% to 18% is a godsend for the industry. In summary, I think most of the businesses operating in the sector will be greatly relieved in terms of the high tariff that we were all actually facing earlier. So all I would say is that most of us would be passing on the benefit completely to the consumers. I think the intent of this is to pass it on to the end user so that the overall products, whether what we sell or our customer sells, becomes lower in cost, and thereby there will be a good improvement in the overall growth of business and economy as such. So as far as we are concerned, we are clear that we will pass on all the benefits. From that point of view, I think the EBITDA or the margin expansion would be limited. It probably would, if at all, will come from the larger volumes that may be offtake by the customer, both at the OEM level as well as in the aftermarket. So the increased volume can bring in some margin accretion, but not otherwise.
Well, indeed. That's not just about the auto component, which has got this GST rate rationalization, but it's also the OEMs as well that will be beneficiary, and they have already started and announcing their price cuts rather. But help us understand in which segments the orders have already started coming. How is the enthusiasm looking like right now? Because once we get those vehicles on the dealer, but before that it has to be made, and all these parts are to be sourced from companies like you. So help us understand what's the current situation.
There are two portions to this. I think the first portion is about the aftermarket part of it, where actually we saw a dip in the offtake from our distributors and dealers, because once they got the wind of the fact that the GST will be reduced, nobody wanted to buy at a higher GST product. So that part of it has probably come down, and from I think 22nd of September, everybody placing an order for a shipment after September 22nd. So that will be a big boost on sales after 22nd on the aftermarket. Whereas OEMs have been buying on a regular basis, they have not really changed any of their schedules actually, because as far as they are concerned, whatever GST we are charging, they take a credit. So for them, it is not really an issue for them. So they have been actually robustly buying. In fact, we have seen good traction in August and September with the festival around the corner, and we expect a good festival season. Largely due to the GST reduction as well. So the volume from OEMs have been pretty good.
So you guided for a 5 to 10% ahead of the global industry, which, while maintaining strong double-digit margins as well. With GST changes, would you like to make any changes to this guidance of yours? I know you said that it's not really going to impact your margins, but the overall numbers?
I think what we're seeing right now is a fairly decent couple of months. First quarter numbers have already been announced. The couple of months have been fairly good. I mean, the double-digit growth that we have projected, or 5 to 10% above the global industry, continues to hold good. Please understand that globally, industry is actually not growing, both in Europe and US. The markets are flat, and despite that, our controls division had some 6-7% growth. So that means that we are outperforming industry. But on an overall point, I think considering also SCS, I think we will have a comfortable double-digit growth in revenues. But in terms of margins, we have given a sort of 12 to 14% guidance. I am hoping that it would be more towards the higher end, not at the lower end by end of the year, without of course the SCS entities. So that is our current position.
Good to note that. But along with that, since you just talked about what's happening globally, the industry is not doing that well. And now there's a additional 25% tariff, which is already at play. The total number is at 50% tariff to all the exports to the US. Help us understand what is the impact right now. Is the business still viable? Are you still doing the shipments over there?
Yes, I think we have recently also made a business update along with our quarterly business update regarding the tariffs. I think there are two portions of it. The first portion was the 25% that was originally levied on India, and also globally levied on various countries at various levels. So if you look at that larger basket, I think 1/3 of that, about 30-35% has been all settled with the customer. Another 30-35% has been agreed with the customer. Only about 30% is pending to be negotiated and settled. So that is the first 25% of the tariff part of it. On the second 25%, which has been of a recent origin, we don't have much of an effect. Couple of points here. One is we are significantly MCA compliant. Secondly, I think the HTS codes, the codes on which these components are imported comes under different categories. Some of the categories have some exemptions. So we have made a statement that the overall impact of this additional 25% tariff, if at all, would be not more than $500,000-600,000 as we have no much impact at all because of this. And even this, we will be able to, and we are currently under discussion with the customer, to pass it on to them. And I think we are fairly clear that the overall impact will be very minimal for us.
But, if I look at the numbers for Phoenix Lamps division particularly, there was a revenue dip and there was an EBITDA drop as well. How do you see this particular division pan out for the rest of the fiscal?
The Phoenix Lamps division, again, we have, as you know, we have multiple divisions. The Phoenix Lamps division per se had one minor setback in Middle East because the Trifa brand, which we have positioned ourselves as our premium brand, was significantly sold in Middle East and from there into Africa and other countries. So that with the geopolitical, rift or the battle, the war that is happening, in Israel and in Gaza, I think that has had an impact of postponing of these decisions by these distributors. So we have said that for the first quarter, which is already announced, and even for the second quarter, we'll have some impact. But having said that, I think Phoenix Lamps also will continue to grow from Q3 onwards. But overall, on a standalone basis, which includes both the Phoenix Lamps, electronics division, and our domestic cable division, we should have a good, robust growth for the current as well as for the balance year.
Right, while we're talking about your segments, your divisions like SCD and SED have also won new contracts in global cables and off-highway clusters. Help us understand, how does the export order book look like for FY26? What's the growth visibility here?
Electronics division again had, last couple of quarters had certain setback because for biggest EV two-wheeler maker had a significant downtrend in their sales, which had affected us. But from Q2 onwards, that trend has been reversed back to growth. So, and also margin improvement. So I think that part has been taken care, and we are expecting a balance year to be a good year for electronics division. Controls division continues to win new contracts and introduce new products to customers. And I think that will continue for the balance year. And despite the negative growth globally on automotive industry, we are very comfortable that we will, come close to a, 8 or 10% of business growth, which would be significantly higher than the underlying industry. So, having said that, with an additional improvements in margins, as the growth is going to be quite good.
All right, which along with that, with the China and Canada tranche of SCS being completed now, I think you have already guided for an EBITDA positive by Q4. Is that timeline still intact, and what are the early signs that you are seeing from the integration so far?
The integration is progressing well within the Suprajit Controls division. On particular point about the SCS Canada and SCS China, The transaction is complete. We are in control and running the business for the last 2-3 months. We are seeing a fairly decent run there. And all the SCS entities, we have said that on a consolidated basis, SCS itself as a division, by end of this year will turn a bit positive. We still stand by that guidance that we have given. And from the pointers that we get from all these entities, I think we are going to achieve that comfortably by end of the year.
Right. Okay. Great to have you then on the show, Ajith. Good speaking with you. Thanks for your time today.
Thank you.
Okay, let's take a very quick break. We haven't marked what the market has settled in for. And, while it was a quiet start in the green, however, it's actually